The One Big Beautiful Bill Act just passed, and it's rewriting the tax code for 2025. If you're not paying attention, you could be leaving thousands of dollars on the table. If you are a homeowner, if you have a job or work for tips or even work overtime, maybe you invest in real estate or you own a side business, this could be one of the most important tax updates you hear all year. And I'm going to share how you can use strategy stacking to save even more on taxes. This is something that most people don't know about. So President Trump just signed the One Big Beautiful Bill Act, and starting in 2025, everything from your standard deductions to your car loan interest might look completely different. Stick around because I'm going to break down exactly what's changing, who it helps, and how you can take advantage of all of that before tax season hits next year. Let's start with what impacts families and individual taxpayers the most, okay? First of all, the standard deduction is going way up. So if you're single, it jumps to $15,750. And if you're married filing jointly, it doubles to $31,500. What does that mean? That means more of your income could be taken off the top if you take the standard deduction. For those of you who are charitable minded, you can now claim charitable deductions of up to $1,000 as a single or $2,000 for joint filing married. So this is a great example of how the government is incentivizing us to be more charitable minded. 529 is also getting more flexible. If you're a parent who's looking to save for kids' college, you now have more eligible reimbursement expenses for K through 12, as well as certain homeschooling expenses, which is brand new. Now, if you have kids, you will love this, right? The child tax credit is increasing to $2,200 per child, and $1,400 of that is refundable. That has been made permanent. Now, there's income limitation to this, and typically this is for couples making under $400,000 as a married couple. For those of you living in a high taxing state like California, New York, Hawaii, the state and local tax deduction cap has changed significantly. It's gone up from $10,000 all the way up to $40,000. So that's a massive shift that could significantly reduce your taxable income starting in 2025. So before we could only write off $10,000 of our state income taxes, now we can write off up to $40,000. Now, if you're someone who is self-employed or 1099, there are some really great new tax perks for you. If you make tip income, up to $25,000 of that could be completely tax-free starting in 2025. So this is huge for people who are working in the restaurant industry, hairstylists, or people in similar occupations that typically earn income. Now, if you're someone who is working overtime, clocking extra hours, you can also potentially now deduct overtime pay of up to $12,500 if you're single, and double that for $25,000 if you're filing married joint. Do make sure it's reported separately on your tax forms in order to qualify. What I really love about this is the government is incentivizing people to work more and also incentivizing better service, right? If you're getting more tips. Both of those now could potentially be tax-free. Something that's really cool and brand new starting in 2025 is that if you are in the market to purchase a brand new personal car and you're going to finance the car, there is now a deduction on the interest you pay on the car purchase. So if the car has final assembly in the US and it's brand new, then you can potentially write off up to $10,000 of the interest that you pay on that vehicle loan. This is super amazing because historically we've never been able to take tax deductions for personal vehicles. So this allows us to now be able to take an actual tax benefit when we purchase US assembled vehicles in 2025. So what does this all mean for you? You know, many of these do have income limitations and other restrictions, so make sure to connect with your CPA to see which one of these may benefit you, what you might need to do to actually benefit from them, right? The earlier you start planning, the sooner you can save on taxes and the more options you have. I hosted a 1-hour workshop to share the exact playbook that we're using with our private clients to take advantage of all these new tax breaks. Check out my link below to access that. All right, let's get to the good part. For real estate investors and business owners, 100% bonus depreciation is back. Starting in January 20th, 2025, now you can fully expense eligible items in the first year. So for real estate investors, remember the old law was we can only take bonus depreciation up to 40% in 2025. But now with the passage of the One Big Beautiful Bill, they brought that all the way back up to 100%. So what does that mean? That means if you were expecting tax benefits from your real estate properties, that benefit just more than doubled with the passage of this new tax bill. So if you bought a rental property and you were expecting $50,000 of depreciation in the first year with cost segregation and bonus, now that benefit could be $100,000 or more. So make sure you work with your tax advisor to estimate what your tax savings is for 2025. Bonus depreciation for real estate investors apply to all sorts of things, such as 5-year assets, 7-year assets, and even 15-year assets. So if you bought a new property and you can use these tax benefits to offset different types of income, definitely consider a cost segregation study. This is basically a study that allows you to break out the components of your building so that you can take faster depreciation. Now, if you're investing in furnished rentals or short-term rentals, really important to know that furniture and fixture may also be eligible for bonus depreciation, which means rather than writing it off over multiple years, the new bill allows us to write it off immediately in 2025. So what does this mean? Get ready to shop for more real estate. Also for real estate investors, the qualified business income tax deduction is here to stay. It was scheduled to expire as of the end of this year, but the Big Beautiful Bill has brought it back. What is the qualified business income tax deduction? In short, it means that for certain eligible taxpayers, up to 20% of your business income could be completely tax-free. So meaning if you make $100 worth of eligible income, $20 of that couldn't be tax-free and you're only paying taxes on the remaining $80. With respect to real estate, what type of income generally qualifies? Property management income, fix and flip income, wholesale income, and real estate commissions are just a few examples. Now let's talk about business tax perks with respect to the One Big Beautiful Bill. Similar to real estate, business owners also get to take advantage of 100% bonus depreciation. That would be on equipment and other similar items where you usually have to depreciate within 15 years or sooner. Now, if you're someone who invests heavily in the stock market, there's now a more favorable small business stock exclusion. If you hold qualifying small business stock for at least 5 years, you might be able to exclude up to 100% of the capital gains taxes that's tax-free. So typically these are going to be eligible small business investments that you make in the technology space or other businesses. So also as business owners, we get an enhanced Section 179 deduction. Similar to the bonus depreciation concept, this means that we're able to write off assets sooner rather than later. The cap for this year now is $2.5 million in eligible new assets. So very, very high dollar amount. Just like real estate investors, eligible business owners can also get QBI, where the first 20% of income is completely tax-free, therefore reducing overall taxes. Now, this is eligible for sole proprietorships, S corporations, partnerships, and LLCs, currently not eligible for C corporations. The third benefit that was retained, which is significantly helpful for both real estate investors and business owners, is the pass-through entity tax break. Again, something that was scheduled to expire, we now have it available again beyond just 2025. And this is really significant for those of you who live in states where you have high taxes. Traditionally, you don't get a significant deduction for personal state income taxes paid when you file IRS taxes. However, the pass-through entity tax break basically allows for your business to pay for your personal state income taxes associated with that business, resulting in a business deduction. In other words, business pays for a personal tax expense, turning it into a business write-off, therefore reducing your overall tax liability. Now, unfortunately, this is an opportunity that has been around for a couple years, but we see it missed all the time. So make sure you are taking advantage of that. How do you know if you are? Well, find out. If you are still paying your personal state income taxes from your personal account rather than your business account, this could be a warning sign that you've not taken advantage of this tax benefit. So make sure to discuss this with your CPA. Got any questions? Comment them below. Be sure to like and subscribe for additional tax saving strategies.